Hey, Eric here from 5minuteinvesting.com, and today we're going to talk about an interesting movement called FIRE, Financial Independence and Retire Early. And this is a concept I've came across a couple of weeks ago when I was listening to a podcast. And basically there was this couple that was retiring at 30 years old and traveling around the world using only 4% of their portfolio. And I was really intrigued by this concept. So then I digged into a bit and I just want to share my view on it and what is FIRES, how does it work, what does it mean to retire early, and what are some of the options that are available to you in order to retire faster. And I'll share some alternative strategies as well on how to retire faster and perhaps easier than the current approach of FIRES. All right, so FIRES really stands for Financial Independence and Retire Early, which is based on a best-selling book called Your Money and Your Life, written by Vicki RobinBy back in 1992. And the whole concept revolves around saving a lot of money, saving a lot of your income so that you can eventually withdraw a very small portion of your portfolio and you live solely off that withdrawal. Now, they have a very famous rule called the 4% rule. That means you only want to spend 4% of your portfolio. That means you're expecting a personal expense of 40K if you have $1 million. And this is considered to be a relatively low amount of spending. Now, when you do the math and they calculate how much personal expense you need to retire, the portfolio size is $1 million. And most people that are within the FIRES movement actually aim at $1 million in terms of portfolio, earning 6% a year from the market. Now, when you think about it, the average return for the stock market from the last 30 years is 7%. And if you invest in a mutual fund or a ETF fund, basically low transaction cost fund, then the management fee is around 1%. Some are a little bit less, some are a little bit higher to 2%. So 6% a year is pretty reasonable if you aim to get an average return. All right. So here's the question. Is this 40K, 4% of your portfolio, really enough for your personal spending? Now, some people will tell you that, well, you will be surprised by how little money it takes to retire, and if you calculate your expenses and so on, it actually turns out to be less than 40K and so on. So in a way, I agree with this, but then I think we also need to look at from a few different perspectives. So the first consideration I have is really tax. When you are getting this 40K, there are two ways you can get it by investing in a mutual fund. First, it comes in as a dividend. Now, when you're looking at dividend income in Canada and US, it's actually one of the highest tax bracket item out of income tax. So you're paying somewhere like 40% in Canada. So when you think about it, you're not really getting 40K after tax. You're getting much less than 40K after tax. And that leads to an important implication because this means 1 million in terms of portfolio is not enough. And if you look at capital gain, there's long-term capital gain in US. So if you are investing in a portfolio, chances are it's going to be long-term capital gain instead of short-term. And in Canada, capital gain is taxed at 25% and half of that. So which will turn out to be around 12.5 if I remember correctly. So this means that your 40K, at least 10 to 30%, give or take, will be taxed. So you want to take that into consideration because that is going to reduce the amount of personal spending you have. Now, second, when you're looking at the return of 6% per year from the market, this is higher than the 4% is because inflation is actually around 2% a year, 2 to 3% a year. So this assumes that inflation is the same year after year, and which is fine in terms of an assumption for the model. So then the next question is going to be, what happens if there's an increase in living expense for you? Now, this might be because once you retire, you have some additional expense that you don't know about, or it's because as you get older, you'll have more healthcare costs, or your family or your son wants to take an extra swimming class or piano lesson. So when you think about it, you need to be very tight on your expenses to be kept below 40K. And I think that is going to cause quite a bit of stress in order to meet that goal. Now, the next thing is really family. Is this 40K sufficient for one person? And that is probably true. But what if you are living, what if you have a family? You have a wife, you have a kid, maybe 2 kids. Then does that mean this 1 million actually needs to be higher? And 1 million is actually not enough. So when you take that into consideration, then you probably need more than $1 million to retire. Okay. All right. So the final consideration is really buffer, because when you look at life, and for the remainder of your life, there are going to be a lot of unexpected events, whether it's a stock market crash, whether it is someone having a terminal illness, or whether it's there's a fire or something, a storm that destroyed your house. So by only spending 4% of your portfolio and trying to keep below that threshold, you're not really giving yourself buffer for anything. And if you say, well, for the $1 million in portfolio, I'm actually going to use that as a buffer if there's any terminal illness or whatnot, then that is going to permanently reduce your portfolio size, which reduces this 40K down the line, and which means you will then have to work until your portfolio hits 1 million again. So I think this theory is great. The 6% and the 4% works in a world that is not changing. And I think that 4% is considered to be low because you're only getting 40K. So either your portfolio is going to be bigger, which is 2 million, or somehow you're going to get a higher return. And that's what I really want to talk about in the next slide. So in the next slide, I talk about a couple of options and the current option, how people are going about it in terms of achieving financial independence and retire early. So the first option is really invest in ETF funds, and you want super low transaction costs. I think the lowest I have ever seen in the market is 0.25% or to 0.33%. Those are extremely low. It's called TDE series. That's the one I remember off the top of my head. But if you ask your bank teller, I'm sure there are more alternatives. And essentially, you'll get around 6% return. And I don't think you should expect anything more than 6% over the long run. And I don't think there's any point in timing the market if you're just investing in mutual fund, because that's what the mutual fund is supposed to do for you. All right, so after inflation, your real return is really just 4% because inflation is around 2 to 3%. And right now I'm using a more optimistic measure of 2%. But if you're looking at how the governments, China and US, are just printing money year after year, you'll realize that the inflation 2% is actually a very optimistic KPI. And I think the real inflation, after you take into account printing money and so on, it's actually higher. All right. Now here is the first alternative I propose to FIRE. Because for FIRE, you're really just investing in ETF funds because you're just getting money on a continuous basis, whether it's monthly or whatnot. So it gives you a lot of flexibility. I think that is good, but in a way, it's not really ideal because the return is really low. Okay, so let's talk about option number 2. So imagine you buy a house. And you put down a down payment of $100,000. So let me just revise here, down payment. And it's worth $500,000 to $800K depending on the area you live in. So right now I'm in Vancouver, so chances are it's going to be $500,000 worth. And this presents a 20% down payment. And if you get an $800K house, you might be able to stretch it if you're in the United States. So this is really important because you're only putting 100K down, but you're controlling assets that are worth $500,000 to 800K. And I'm going to assume that you find a good property that is cash flow positive. And this is quite important because if you are not working, then you need the property to be cash flow positive. And this is going to be taken into consideration. This is going to be taking into consideration property tax, your operating costs like utilities, whatever, Wi-Fi, interest, and so on. And ideally, it should be cash flow positive, including the principal payments, which means your tenants is actually paying down the house for you. But if it is not cash flow positive, including the principal payments, then it would be a so-so investment opportunity, but it would still be good because your house itself is cash flow positive and you're just paying down a mortgage. All right. Now, assuming the house grows at around 10% year over year, this means you're going to be making 50 to 80K in capital gain, paper gain each year. Now, a 10% growth, it is actually quite aggressive. And if you go Google and you search what is the return for real estate year over year, it's actually around 7%. So if I change this to 7%, it actually doesn't make too much of a difference because that's going to be just 45K. So it's down by 4K, and here is around 56K. Yeah, okay, that's right. So 45K to 56K increase a year for a $500,000 to 800K house. Let's take a minute and think about this. 100K, that is what you invested, and you are making 45 to 56K a year on your house as capital gain. Now you haven't sold the house yet, but that is what you're making. That is actually quite interesting, right? Because this already fulfills the requirement of minimum 40K personal expense. So imagine if you just sell the house today and it's cash flow positive, and then you just pay for the agent's fee, which is around $3,000, you already make 45K. You see this? With only $100,000. So you actually didn't even need to save $1 million to reach this 40K of personal expense year after year. That is quite an interesting and obvious breakthrough, right? So that means you actually don't need to save that much money. And I'm a firm believer of not saving a lot of money because the more money you need to save, that means the longer time it takes for you to retire. All right, so this is an important equation. Now, for some people like who are living in Vancouver or San Francisco or New York, your capital gain is going to be a lot higher than 7%. I think during some of the years in Vancouver, the housing prices were increasing at 20%. So imagine that. Now, of course, when you buy a house, you don't want to be selling it right away. So you want it to grow and kind of snowball for a couple of years first, and you just want to let it grow. Now, there's two approaches to this. First, there's a conservative approach. Now, the conservative approach is really about buying two properties. So instead of just saving down $100,000 and leaving it in a house, you can save $200,000 and buy two houses, and then two condos in this case. And then that will allow you to get around 90 to 100K a year in terms of capital gain. So then when you cash out later, it's going to be quite a significant amount in terms of capital gain you get. Now, why is it generating such a high return? Now, some people will say, well, it's obvious, it's real estate. But the reason why you're getting such a high return for so little capital invested is really because you're getting a mortgage. And that is going to be the key part because you're using leverage. And using leverage will always multiply your return. And this is why real estate is such an attractive investment. And if you're just saving to dump your money into ETF without investing in real estate, then I don't know what you're doing. All right, let's talk about an aggressive approach. Now, in order for you to buy two properties, Sometimes some people are going to aim for more. I know someone with over 100 properties. But essentially, if you want to buy 2 more properties, you might want to use a concept called releverage. So that means as you pay down the house, let's say you pay down the house of the mortgage, instead of 400,000, now it's 350, so you have an equity of 150,000. You can actually take 50,000 out of the house again as leverage, and you just increase your mortgage payment, so that now you have $50,000 cash. Now, whether you want to spend it or you want to reinvest, that is going to be a crucial decision. Now, if you are going to retire, then of course you can take it out and then you spend it. But if you embrace the concept of delayed gratification, then you would releverage the house and invest in another house. Now, in the short term, your mortgage payment is going to go up, which is going to be painful. But in the long term, you have another house that is making 7% capital gain for you, which is 45 to 56K every year. So if you releverage after the house has been paying down for 2-3 years, then suddenly you have a second or even a third house. And this really allows you to achieve your goal a lot faster than investing in an ETF fund. And this is really the reason why I don't ever invest in an ETF fund, because there's no leverage in it. So yeah, there's no leverage in it. It's as simple as that. But the biggest problem with buying a house really comes down to how do you get this 100K in terms of down payment. And I think a lot of people, you just need to save a lot of money to get the down payment so that you can invest in a house. Then the second property will be a lot easier. And because it is quite difficult to get a down payment of 100,000, especially when you have a family, you have kids, you have work, and you have all these other things going on, I want to introduce you to option number 3. Now, option number 3 is investing in the stock market and get 30% using long-term stock options. So again, this is a leverage strategy, which is similar to number 2. And that is also what I teach in my program called Investing Accelerator. And I target to make around 30% year after year. Now, there's a couple of implications for making such a high return. So first, when you make a high return like this, it allows your portfolio to grow a lot faster. So if I invest 100K today, and if my portfolio is compounding at 30% because I use leverage, it will be 1.1 million in 10 years. And if you do the same for real estate, it's going to work out around to be the same number. So $1 million or something in 10 years. Except I do this for stock markets instead of the real estate market. Now here's what's interesting. The stock market is actually a lot more lucrative and a lot more easier to get in and out of. So that means extracting cash from stocks is going to be a lot easier. And I only need to save 100K. And both option 2 and option 3 requires a significantly less amount in terms of savings in order to achieve the same goal of 4% in terms of portfolio and 40K in personal expense and reaching $1 million in portfolio. So both of these options will allow you to retire earlier and achieve financial independence. Now, there's actually a second implication to this. If you earn a much higher return than 6%, then this also means you can withdraw a higher amount than 4%. Now, when you think about it, you can only withdraw 4% in option 1 because you're only making 6%, and if you minus inflation, that only gives you 4. So that's the max you can go. Like, you can't even withdraw more, or else you're eating into your capital, which is actually quite interesting. So yeah, so if I do the math for you, if you earn 12% a year, then you only need $500,000 in your portfolio instead of $1 million. So that is 50% less. So instead of $1 million here, you only need $500,000. So imagine it takes you 20 years to save $1 million. Now you only need 10 years. So the return is crucial. And right now I'm assuming you're starting with $500,000 portfolio. I haven't assumed that you're going to contribute on a monthly basis. That is going to accelerate the progress even more. And if you earn 18%, which is still below 30% I'm aiming here, then you only need 333K in your portfolio to achieve the exact same result as this equation here, 6% minus 2% equals 4%. So that is 66% less. So if you think you need 20 years to save for retirement, now you only need 33% of that, which is around 6 years. So you can see how many years you're saving by earning a high return. And of course, the portfolio will grow faster. You don't need to save as much money. Of course, you still want to save money because your capital is your portfolio size. So you want to save and grow that. And it will also allow you to save for a second house faster. So earning a higher return from the stock market using something like stock options is crucial. And this really allows you to achieve the results of the movement fires in a very short amount of time. Yeah, so that is pretty much all I want to cover in this video. I personally aim to get 30% every year, and so far my return is 44%. So I'm getting there really soon. If you have any questions, you can leave a comment below, and you can also share it if you like this video. And yeah, let me know whether there's any other topics you want me to cover. Talk to you later.